Hello investors, thank you so much for joining me. My name is Michael from Deep Value Returns from Seeking Alpha. Today I want to talk about Stitch Fix's results for Q2 22. They just reported their results last night. Gonna go through that and talk about the fact that the business has downwards revised their guidance over the past 3 quarters, starting really with Q4 21 when they gave out the full year 2022 guidance, and since then, so they put out their guidance and the downwards revised and the downwards revised again. And as it stands right now, the stock is down a little bit. It's down about 18% as I do this after hours. But when it comes down to it, I think that when investors look back over the next 6 months or 12 months, they're going to look back and think, actually, the shares were really expensive right then. And I know that the stock has been one that's, there's bulls and bears on both sides of the equation. But I think that as we go through this, I think that you'll realize that the risk reward here isn't that favorable. It's really negatively skewed in the wrong way. So as we go through this, just keep in mind that Stitch Fix's fiscal year and calendar year are misaligned. I'm only going to talk about Stitch Fix's fiscal year. Okay, so we're just going to jump right in. As you can see here, the stock is down substantially in the past 3 months, and the after hours reaction is down approximately another 18%. So it's down meaningfully more than 50% in 3 months. Incidentally, 3 months ago, I wrote the article about Stitch Fix, and I said, although the stock looks cheap on the surface at slightly over 1x forward sales, it's difficult to get behind this stock and become a cheerleader here. I then went on to conclude the article saying that the difficulty of being a contrarian investor is that it's saying that the market is wrong and your variant view is right. And that's fine, but sometimes those investments don't work. And amateurs get frustrated, or professional investors understand this. It's just part of the game. There will be winners and there will be losers, and if this is a loser, so be it. Your strategy to deal with losses is what distinguishes an amateur from a professional investor. Whatever you decide, don't wait for the stock to break even. Because remember 2 things. First, nobody knows the price you pay for the stock. The stock will go towards fair value, whatever they may be. And secondly, professional investors realize that you don't need to make your capital back the same way that you lost it. So I mean, it's just echoing here, pretty much everything that happened in the past 3 months. So I wrote that article at $18 a share. The share price now is $9, so it's down 50% in 3 months. So I mean, you can, I don't know even where to start. So basically, they've kind of they're guiding to be down. And in the year, probably by my estimations, exiting Q4 at negative 11%. So, for a business that describes itself as the global leader in curating personalized styling, it's moving in the wrong direction. It's difficult not to kind of get facetious about this, but yeah, so I could start in many different ways here. So the guidance at the end of Q4 21, when they put out the guidance for this fiscal year, was for them to grow, as you can see on the screen, by 15% year over year. Okay, so they were guiding to grow at 15% year over year. Everyone's like, I'm not quite sure about this. This appears to just be a COVID winner. Probably, there was a lot of kind of argument about that at the time, and I was listening to both bulls and bears, and yeah, so that was the guidance. And then at the end of Q1, they said that actually, that 15% guidance, scrap that. We're going to go with net revenues growth rates of high single digits for the year. So they're pointing for, let's say, high single digits, let's say 8 or 9% top line growth, because, they were lowballing to allow themselves some wiggle room to surprise the street. And then they said in yesterday's press statement, actually, no, scrap that. We're going to go with flat to down slightly for the year. So every 90 days, they just kind of say, okay, actually, whatever we thought before, it's actually getting worse, and whatever we thought before, it's actually getting worse. So, I mean, yeah. So what it actually does is curates apparel to customers' style, okay? It's supposed to take the stress away from the customer. Customers have a lot of choices. When you look at, for example, the example of could be Amazon, or other marketplaces exist. There's just so much stuff there. You don't know, like, I just need something simple. You can look at other places as well. You can look at, let's say, Booking.com. There's like, do I want this house? I want that house. It's just so much choice, and you're just like, oh my God, I don't even know where to start. So this is the idea that it's personalized. It takes you and on your journey and gives you what you want. Okay. During the earnings call, the CEO Elizabeth Spaulding, she's 2 years into the job. She talks about the long-term success of the company despite recent and near-term challenges, and how the company continues to be on a path to be the global leader in personalized styling. Okay. I suppose she has to say that because the management, they got to paint a good picture, right? Otherwise things are going to just unfold from there. But they did candidly talk about that active customer conversion is not gaining enough traction, so that's not good. And they also did talk about how the recent iOS changes is making it more difficult for their marketing efforts to be successful. So they also talked about that as they've come to lap their high dollar referrals from last year, the number of active accounts is coming down. There's more dormant accounts surfacing, and that's gonna start lapping right now in this quarter. So, and the other thing that I kind of think is a bad use of capital and a serious misjudgment of capital allocation is that they repurchased 11 million shares during the quarter. So they repurchased, by my estimations, at around $13 on average, and the share price is now 9. So you've kind of bought at, let's say, 40% higher share prices. On a positive note, the business holds no debt, and it has approximately 350 million of cash and cash equivalents. So it's a debt-free business trading with more than 300 million worth of cash. So if you think of the market cap, that is the bull case here. Like, if you think of the market cap, approximately a third of it is made up of cash. So you kind of get an upside optionality, but it's not really that cheap, and it's kind of like, that's a bit of a stretch to say that, but I just wanted to highlight something positive. If you kind of shareholder here and you're kind of looking at this, I just don't want you to think that I'm just pointing everything in the negative slant. EBITDA margins are compressing. So in the back of Q4 results, they talked about EBITDA margins being at approximately 2%, and then at the back of Q1, they said actually no, it's going to be closer to 1 to 2%, and now yesterday they just kind of pulled the EBITDA margin guidance. They said, okay, we have absolutely no idea how this is going to unfold. So I make the argument that as we come to exit this year, it's kind of difficult, but like in the best case, it's going to be EBITDA margin is going to be about negative 2%. In a more kind of fair assessment here, in a base case scenario, it's probably going to be negative 5%. The EBITDA margin. So it's tough, right? The business is going for a difficult spell right now. So it's kind of difficult to figure out what the intrinsic value here is. It just comes down to it ultimately, at what point does the business stabilize? Now I'm going to go through 4 points here that I think are quite interesting. If you can maybe pause the video and have a look here. So I put 4 arrows here, and you can see here, so I've highlighted that the biggest source of capital infusion is the stock-based compensation. Obviously, share price is going down. That stock-based comp isn't worth that much. You need to if you want to retain high-quality management, you're going to have to start paying them in a cash way. So that non-cash expense is going to soon become a cash expense. So that's something for you to keep an eye on. They're liquidating their inventory quite a rapid rate. You need inventory if you're going to grow your business. It's as simple as that. They're extending the payables on their you can only do that so far. You're not Amazon. You haven't got that much purchasing power, and you haven't got that much negotiation power. If you're messing up with your merchants that much, they'll just leave. That's fine. And then deferred revenues is cash up front. I call this liquid gold because it's cash up front that you get for revenues that are going to be recognized over time. That has turned negative in the past 6 months. So, it just shows that the path from here is not looking that great, but this we've already discussed it a few times already. So those four things are really going to reverse very soon, and they're going to burn out a lot of that capital that has been provided for the business in the past 6 months. Yeah, so that's pretty much it. I think that I just hope that people don't look back in like 3 or 6 months and say, actually in hindsight that was a high price uh, to to get involved in this business. It was too high. I should have waited a little bit. When it comes to dealing with bad news in investing, you just want to deal with it straight away. You don't want to kind of like, oh, we like just if you recognize that you made a mistake, that's it. I'm out. And stocks ultimately don't trade in a vacuum. There are really some very compelling investments out there right now. There's some really good cheap stuff, and there's better opportunities to deploy your capital. So if you want to find out where I'm deploying my own capital, don't forget to check out my marketplace right there above the screen, Deep Value Returns. I highlight for you high quality, actionable investment insights. Check out the reviews of other people said about my business. And yeah, I hope to see you guys soon. Good luck throughout the end of the earnings season. See you soon. Bye bye.